I believe when we look back on this, we will see that we're already in a technical recession right now. The third quarter numbers are coming out. People are talking about 4%, but that's mostly AI databases. About half of the GDP is that. That's all we got going on right now is database building. Every other part of the economy is rolling over, and people are feeling it.
Ed Dowd, founder and managing partner of Finance Technologies, a global macro alternative investment firm. It is so wonderful to welcome you back to the show. Great to see you as always, Ed. It has been way too long. Thrilled to have you back on today.
Great to be here. Thanks for having me on.
Well, we love having you on this channel and this show. And I was looking, I think it's been about 9 months since we had you on. So it's about time for a check-in here. And I know you've been in a high demand. A lot of folks want to talk to you. This audience loves having you on. So since so much has happened in that time period, Ed, I want to start with your macro view today, where we are, where you see things headed, what is on your radar, what are you paying attention to, what are you concerned about? And as you know, Ed, on this show, you can take all the time you need to set the table when it comes to that big picture macro view.
Sure. So we put out a U.S. economic deep worldwide recession report in January. It's still relevant today, and if you haven't purchased it, you should buy it. Here's the deal. When we issued the report, we were concerned about the hangover from the Biden administration, which had floated the economy through illegal immigration and deficit spending. And at the time, we predicted that the housing market would probably likely start to roll over. That's in process. That's occurring. Yields at the time we put out the report, the 10-year was at 480. We recommended to our purchases of the report to get out of risk assets and purchase U.S. government securities and kind of like raise cash and go to the sidelines, much like Warren Buffett's already done. So yields since then, the 10 years at 407, the 30 years come down, the Fed has lowered a couple times. And the payroll numbers that we talked about at the time did turn out to be fraudulent under the Biden administration. The jobs layoffs are now accelerating in real time. We have Amazon with, I think, 30,000 employees, UPS with 46. The Challenger jobs report came out yesterday. It was dismal, the worst October in like 22 years or something crazy like that.
Yep.
So things are accelerating. So what we said is coming to fruition. The only thing that's not apparent to everybody is the stock market. That is still covering near all-time highs. It's classic bubble stock market mania. It's being driven by 7 stocks that are 40% of the S&P market cap right now. It's the AI stocks, and we are at a feeding frenzy of AI circular. They call it the circle jerk of financing. There's no money to fund all this. This is the problem. They want trillions of dollars, but their revenues aren't there. The ROI is not there. And the markets are starting to figure this out. And that's why they're doing all these circular deals to keep their I guess, the momentum of hype going. And then yesterday or the day before, Sam Altman and Jensen at the same time said 2 things. They wanted, Jensen said, China's going to win. And Altman said, we need a government backstop, basically. And then he denied it. Then it came out that 2 weeks ago in a memo, they asked for a government backstop. They want government guarantees. So that signals to the market a couple things. What does that signal? That signals that the financing of this bubble is coming to an end. We're starting to see it in CDS spreads, credit default swaps. CoreWeave is exploding up. Oracle's exploding up. And so the financing is getting tight because the credit markets are starting to tighten in general because there's economic woes. We saw some subprime auto companies go bust. So the credit markets are tightening. And so the financing for this whole I guess, momentum AI hype is coming to an end. And Jensen and Altman told you that because they want a government bailout at all-time highs on NVIDIA stock. So this is a signal that demand is rolling over and financing is getting difficult. So the end days are near. I suspect the Trump administration will, take equity stakes or do something. Today it came out they're trying to figure out that they denied it yesterday. David Sachs denied it. But then today we're seeing Pulte talking about using Fannie and Freddie to take stakes in these companies. This is madness. They're buying at the top. And once they do this, I suspect those stocks will have one more pump and then it's over. So we're just waiting for the S&P 500 and the rest of the global indices to roll over. They also have similar characteristics. They're very narrow markets. And the stock market is kind of hiding what's going on the street. And what's going on in the street is a disaster. And this is, we tried to tell the Trump administration they should have a sit down with the American people and say, look, there's going to be a hangover from our policies to get us to the golden age. They're now declaring the golden age is here. That's wrong. Affordability is not, inflation is coming down, but it's not coming down as fast as people would like. There's still healthcare costs rising because of the COVID debacle. So we are at the precipice of this becoming apparent to the masses. But, if you look at what the institutions are doing, they're starting to slowly reallocate to treasuries, which is the safety trade. And we're in the distribution phase of the stock market, meaning the insiders are selling to the retail investors. And if you look at insider sales, they're at unprecedented records. So we're close. I believe when we look back on this, we will see that we're already in a technical recession right now. The third quarter numbers are coming out. People are talking about 4%, but that's mostly AI databases. About half of the GDP is that. That's all we got going on right now is database building. Every other part of the economy is rolling over, and people are feeling it. And look, I call balls and strikes. I voted for Trump. But they came out yesterday and they basically gaslit everyone, said the economy's great, jobs are coming back, and affordability is fabulous. And that's just gaslighting. The economy's not great. We're hurtling towards a recession. And then we put out a China report this week. It's not priced for retail. It's priced for institutions, and it's a deep dive into China. China's at a crossroads. Their real estate crisis is about to go acute. And that's going to have global implications. And long-term, China is going to be something we have to contend with for years to come. They hit a demographic wall in 2020, and that started their real estate crisis, and their internal consumption and demand started to plummet. So what did they do as a nation to keep the engines of growth going? They started exporting more. So their exporting took off in 21 and 22. That's why we're having trade wars. They have installed industrial capacity that's, the demand internally is rolling over. So they need to export that to keep the people employed. And that's going to happen for years to come. One thing that people aren't aware of is that China used to be 80% priced in US dollars. China was 80% of the US GDP. Since 2020, they've been depreciating the yuan. So priced in dollars, they're now 60% of US GDP. And their growth priced in yuan is 5%, quarterly GDP growth. In US dollars, their growth is zero. So they're in trouble. We have more cards than them at the moment. And so this narrative that China holds all the cards is bogus, but and they're trying to save face, but we don't hold all the cards either. So there needs to be serious negotiations with China to get this problem resolved, because they're going to be exporting deflation for years to come. And so we have and they're about to hit the acute phase in their housing crisis, because construction projects that were kind of still ongoing since their real estate collapse are now starting to roll over. So that's going to affect a large part of their industrial base. So they're exporting to get out of this is going to increase,
which leads to the inflation, the deflation part.
Correct.
Got it.
And by the way, tariffs are deflationary. They're not inflationary. That's why everyone's seen any inflation.
Yeah.
This is economics 101.
I think Dr. Hunt has talked about that too. Dr. Lacey Hunt.
Dr. Hunt. So Carlos and Dr. Hunt and myself have been in contact. We talk all the time. This is microeconomics 101. Lacey's right. Carlos, my partner, is right. And they're deflationary. And the Fed, to make matters worse, is too late. They've kept interest rates too high for too long. And dollar liquidity is drying up globally. And you're going to see the dollar rip versus other indices into the midterms. The dollar's put in a very important 4-year cycle low. And that's not, I monitor all different asset classes. And that's why I know a stock market problem is coming. Treasuries are bid. and the dollar's bid, and that means a risk-off environment is coming. And if you look at Bitcoin, Bitcoin is usually an early harbinger. Bitcoin is now year to date underperformed U.S. Treasuries or performed slightly worse than U.S. Treasuries. So Bitcoin is probably going a lot lower. That's an early warning indicator of liquidity drying up. Nothing against the Bitcoin people, but it's not a store of value. It's a speculative instrument that's 95% correlated to the NASDAQ, period, and stop.
It's a liquidity indicator, as you point out. One of the things about you, Ed, you have a background in fixed income and in equity. So I find
Correct.
this, like, you have this like breadth of knowledge of these different assets. You mentioned the dollar. Okay, this is interesting too. Like the dollar, that you see it's going to rip. Very different from what I've heard from some other guests, like their views on the dollar. And right now, last month, everyone's talked about the debasement trade or whatever. I want to hear your thoughts on the dollar, because that's interesting. This is a bit different from what I'm hearing. So let's go there.
Yeah, so there's a dollar liquidity shortage caused by global slowing economic issues, plus the tariffs. So there's a dollar liquidity issue going on, and that's going to continue to show up in other currencies going down. So this is, and when the dollar is in a decline, it's bullish for risk assets because it's basically credit creation. When the dollar starts going up, it's never 100% correlated. One of the reasons for the dollar going up is credit destruction and dollar shortages, and that's what we're seeing, and we're going to see. And I think that the dollar is going to blow people's minds 6 months from now. All those people on the debasement trade are going to be trying to explain themselves, and there's going to be a flight to safety. It's just this is just technical, and I'm seeing it.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. You were talking about the dollar's going to rip. The Treasury's bid right now that we're seeing, it's signaling this risk-off environment. You point out also Bitcoin is an early harbinger. So talk to me about the risk-off environment, like where you see, where is the capital going to go? Like, what are the assets that people are going to flock to?
Well, in our report, and as I indicated earlier, they're going to go into treasuries, U.S. treasuries. This is classic. There'll be a flight to safety, a slowing economic growth scenario, and a risk-off trade always indicates a flight to safety. And everyone in the last year has been talking about yields going up. While in a deflationary environment, yields go lower, and that's what we've been predicting. You can't have a roaring economy with the housing market rolling over. It's 20% of the U.S. economy. You can't have an economy ripping when consumer sentiment is where it is now. And basically, if you look at consumer staple stocks, they are down 30, 40% year to date, and there's a reason for that. And, look, the risk-off trade is already occurring underneath the surface of the market. If you look at the equal-weighted S&P 500 index, it's gone nowhere since January. So there's this, this euphoria that the markets are up, but they're up. What's up are the 7 stocks, the 10 stocks related to AI. And when you have that kind of crowding into that few number of stocks leading the indices, it's usually the end. We saw this in the 2007 bubble. There were 6 or 7 stocks leading. We saw it in the dot-com bubble. And breadth underneath starts to deteriorate. And now in the last 2 weeks, we've had 3 Hindenburg omens, which is nothing more than a measure of breadth, meaning the number of stocks hitting 52-week lows versus the number of stocks hitting 52-week highs. It's mathematical calculation on a green day indicates that the market underneath the surface is a disaster. And that's what Hindenburg omens predict. They're not always accurate, but they predict a very unhealthy market. It's literally the bus is being driven by a very few number of stocks.
Yeah, it's extremely narrow. Another just question for you, because when we were talking about the debasement trade, a lot of people were talking about gold and gold's rally that we've seen. Gold is still above 4,000 at the moment. Is gold one of those assets in a risk-off environment that people go to? Or like, what is your take on gold?
Gold has already had a fabulous move. I like gold long term. Gold's going to 10,000 by 2030. There's a phenomenon going on that's being driven by gold becoming money again. The powers that be have made gold tier one capital at banks. So that means that you can lend against physical gold. So there's a demand and a bid for gold. China has an enormous demand for gold because China, to keep growing, has to debase its own currency. We calculated 10% a year. So they're going to have a constant bid for gold as people inside China try to protect their own wealth. Central banks are accumulating gold, and commercial banks are accumulating gold. So the gold bid will be there. Gold just hit 4,400. It could consolidate for a year. It may even go down 25 to 30% in any kind of, margin call, systemic fear scenario. That's a buying opportunity because gold long term is going higher. So I don't trade gold. Don't be up to your eyeballs in levered futures on gold, but use any dip in gold as an opportunity to buy more. Gold long term, I'm bullish on.
Yeah, it's just one of those popular topics on this channel that comes up too. Okay, so when you look at the markets right now, obviously it's extremely narrow. It's not a healthy market. Yet we've had the stock market at all-time highs, and I think a lot of people intuit this, Ed. They sense like these markets are completely disconnected from what they feel in their everyday reality, like in the economy, like this disconnect. Why do you think the markets haven't recognized that? Like, why is it so disconnected?
It's got to do with momentum. These things need to exhaust themselves. So asset managers are underperforming their indices, so they chase what's working, and what's working is fewer and fewer stocks. We also have an administration that has decided that they're going to go all in on AI. So the administration is helping foment this bubble, and that's going to come back to bite them in the butt. Realistically, the gating factor on AI was NVIDIA chips. Now the gating factor on AI is power consumption, and so once the reality is starting to dawn on people, we don't have enough electricity and water to fund all these build outs. That kind of pauses the excitement in the whole, mania that's going on. And additionally, AI usage is rolling over. I've looked, I'm a fundamental analyst. I've seen some charts that show that the subscription uptake of OpenAI is rolling over. So it's a second derivative change. We've seen that from Yale studies and MIT studies that AI adoption in pilots at corporations are yielding no ROI. So corporations aren't that enthusiastic about it. They're using it as an excuse to announce layoffs. So this AI Armageddon that is being propagated in the mainstream media, these layoffs are all AI. That's not true. The AI is not ready for prime time. AI has a hallucination rate of 25%. I mean, and look, I was a big fan of AI initially, but now I've realized that it makes a lot of mistakes. So I used to use AI as a new search function. Now I have to go back to Google to verify a lot of the facts. So it's become cumbersome. So, and a lot of people are telling me the same thing. AI is going to be great someday. This reminds me of the dot-com bubble, where you knew the internet is a real thing, but it was overhyped and not ready for prime time. Same thing. AI is not ready to change the world yet. It will, but this is the hype phase of any new technology, just like railroads, just like broadband. And here we are again. Too much investment, too much compute power, and no real test case uses. And, when Sam Altman started talking about, introducing essentially porn, AI porn, that told me that the demand is, that demand wasn't as great as we were led to believe. And I think people have to understand, yesterday when they asked for a government bailout, that is at sentiment being, with NVIDIA near all-time highs, because NVIDIA is the public way to play this. OpenAI is not public yet. That was the signal. They're seeing, real demand degradation and financing problems. So that's telling you something. That's an admission that things are worse than we've been led to believe. And they have to, they have to hype to get investors to give them money. So, and Sam Altman's not necessarily a very truthful man. He's been caught in several lies. So this whole thing, I think, is coming to a head. I do think the Trump administration will cave and, take some equity stakes in some of this stuff. And we'll get one more pump up in the stocks, and that'll be the end, because there's no revenue there. There's no revenue.
What is the mechanism for that? As you put it, like one more pump and it's over, like in the market, your thesis. What is that mechanism for that?
The mechanism is Trump somewhat, if Fannie Mae makes a tech stake investment, the public stocks that, are feeding the AI cycle will have one more push up, and then that's it. It's classic. I would not buy that top. I'm not telling people to short. Shorting is very difficult, but if you're putting new money to work in 7 AI stocks, you're gonna be looking at severe losses 2 to 3 years from now.
This episode is brought to you by VanEck's Rare Earth and Strategic Metals ETF, ticker symbol REMX. Rare earths are the hidden backbone of modern technology and defense, powering everything from smartphones and electric vehicles to fighter jets and wind turbines. VanEck recognized this early, launching the Rare Earth and Strategic Metals ETF, ticker symbol REMX, 15 years ago, well before supply chain security became a global priority. Today, China dominates the production and refining capacity of rare earths, creating real challenges for global supply chain security, as these materials are essential for technological innovation, clean energy, and national security. That's why countries all around the world are racing to build their own supply chains and reduce reliance on China. As this global shift continues, investment in the rare earth ecosystem is growing rapidly, from mining to advanced manufacturing. Investors can gain access to this powerful trend through REMX. Visit vaneck.com/REMX Julia to learn more. Okay, so, and yeah, one thing too, some folks will often point, not folks, but some people will often point to retail buying, record retail buying in the markets. I've had guests who've come on and pointed out that's actually a sign of a not healthy market. It's actually not a bullish thing. The retail is usually the last.
Yeah, no, that's called FOMO, and FOMO is real fear of missing out. And I was on a call. I'm an advisor to a fund of funds product, and some of the people invested in the fund were disappointed that the return of the fund for 1 month was 1%, and the S&P was up 4%, and they were questioning some of the this fund of funds is not going to get hurt in a downturn, so they didn't keep up with the 3% move for the month. So there's this FOMO, and we had to explain to them, well, the S&P is up because of 7 stocks, and this is why you're invested with us. We're not chasing 7 stocks.
And do we have warped perceptions of what returns should be then too? Because these have not been like normal years.
Not normal years. And by the way, the faster a return occurs, not so much in a individual stock, because individual stocks can have big, outsized returns in any given year. But when a market has outsized returns quickly, like the unprecedented rally since the April lows, you need to question that. What's going on? And I do believe, typically speaking, retail investors are the last to the party, and institutions are selling to them, and insiders are selling to them. So, that usually doesn't end well.
You mentioned earlier when we were talking about the Federal Reserve, they were too high for too long. We've had, for the last 2 FOMC meetings, 25 basis point cuts. I don't know what the December one's going to be, because the FOMC presser with Powell was not a foregone conclusion that they were going to cut or not cut. What's been your take on the Fed and the policy decisions of late? How are you kind of reading into it or assessing it? What do you make of it?
Well, so they well, during the Biden administration, they were keying their decisions off bogus non-farm payroll numbers. So that was a problem. They thought when Trump announced the tariffs that inflation was coming. That's not occurring. In fact, inflation is coming down, and we'll get a deflationary scare soon enough once housing collapses, because housing is 36% of the CPI, and that's coming. So they're going to be behind the eight ball. And I suspect when things really get going and we see the credit markets blow out, there's some bank issues, bank stocks start collapsing, and the general indices start going down quite a bit, we'll see the Fed panic and cut 50 to 100. I don't know when that's going to, it could happen before the end of the year or sometime in the beginning of the year, but the Fed will panic at some point because they're so behind the curve. And it takes 18 months for interest rate cuts to actually affect the real economy. So these cuts, won't save the stock market. They won't save risk assets. Eventually there'll be a risk asset rally, but not anytime soon.
Should they have been cutting like long before now? Like what should they have?
They should have been cutting in 2024, and then once the tariffs came on, and Lacey Hunt has talked about this and documented this quite well. Tariffs are a tax. Tariffs take liquidity out of the system. So the Fed during the tariff, the tariffs in the Great Depression did not lower interest rates and provide liquidity. Same situation. Liquidity is leaving the global markets, so money is tight everywhere, and it's starting to show up in the credit markets. I mean, we finally see the CDSs of the AI markets go up, and that's a function of too much AI debt coming at once and issues in other parts of the credit market. So people in the credit markets are starting to question the growth scenario right now, and that's why there's been a bid on the 10-year and a bid on the 30-year. And once people realize how bad it is, and that's coming, you're going to see the 30-year go to 3% super quick, the 10-year go to 2.5%. It's all going to happen, you're not going to be able to get in the trade fast enough.
That's interesting, and that's why I put it out earlier. Your background in fixed income too, like looking at the credit markets and what it's sniffing out before anything else. Is that what you're referring to there? Like it's kind of gleaning something that's happening.
And let me give you a little historical. I was at BlackRock in the great financial crisis. I was an equity growth portfolio manager, but I had spent 5 years as a bond salesman at HSBC.
Mm-hmm.
And at BlackRock, before they went on all their acquisition sprees, it was quite a very fundamentally focused firm. Now it's all passive investments. But back then, we had a morning meeting. And the bond guys and the equity guys all got together for 30 minutes and went around the table and talked. I remember in 2007, the bond guys, and because I'm a former bond guy, and I think bond people are generally more risk averse and usually early to see the warning signs, and not storytellers. A lot of equity people are storytellers. The bond guys are usually the first to move. And I remember at BlackRock, our bond guys were freaking out. Absolutely freaking out for most of 2007, while the equity folks were still partying, poo-pooing the bond guys. But the bond guys ended up being super right, and the equity guys, a lot of people at BlackRock were on the wrong side of the trade when the bottom fell out. So this is the same thing. The credit markets are telling you something. The Treasury market's telling you something. Yields going lower is not a sign of economic strength. It's a sign of economic slowing. Especially, the story had been unprecedented inflation. So the fact that the bond market's going lower in the face of this inflation talk is telling you the bond market is sniffing out not only lower inflation, but a deflation scare.
A deflation scare. Elaborate a bit more on that, though, because that scenario, that's not the scenario anybody wants, but elaborate a bit more on the deflation scare.
Yeah, a deflation scare is basically a credit crunch. Okay. Mm-hmm. And, look, the banking system, the mantra of the bankers are inflate or die. So credit deflations are not allowed. So what we suspect is going to happen is that we're going to get this deflation scare. We're going to see oil go to 30. We're going to see, we're going to see as all this, you're going to see a credit crunch. You're going to see bank issues. Then the Federal Reserve is going to come in guns blazing again and do QE, the fiscal response. So we're going to be, it's basically the deflation scare will be brief, and then they're going to try to reinflate it again. And so that's where we're kind of in this 1970s stagflation period of inflation scare, deflation scare, pump again. This is where we are. We're going to be in this yo-yo trying to save the system. It's kind of a disaster. It's not pretty.
No, it does not sound pretty. And like stagflation is like historically the worst environment for pretty much all asset classes. Okay, oil, $30 a barrel. Okay, explain the oil one to me. I want to hear more on that.
Well, when we put out a report in January, oil was $78. It's now $60. Oil in a strong, robust economy should be ripping. It is not. Oil and once the U.S. economy goes into a recession, oil will go to 30. Oil is also reflective of what's going on in China. China's internal consumption has been plummeting. So if you remember, you may or may not remember, but during the early 2000s, oil, went on a bull run after the dot-com bubble into 08, went from like $30 to 180, I think was the top. And that was all China internal consumption driven. China was, demographically growing. Their young workers were buying cars. Now we have the opposite. They're in a peak worker demographic decline. It's so bad that's why oil is where it is. And oil is going to 30 just because it's going to. Technically, it looks like that. And unless there's a war in the Straits of Hormuz, oil is going to collapse to 30. It won't stay there long, and gas prices will come down during the recession. But then they'll come back up because, I know what's going to happen. We're gonna print money. We're going to run big deficits. There'll be all sorts of, Trump likely loses the midterms if this happens before the midterms. It's bad. And the Trump administration had an opportunity to communicate this to the public, but they decided not to because they thought they could bridge the valley and the hangover from the Biden. They thought they could bridge the gap, and they can't.
Is it too late to communicate it?
Well, yesterday the White House was putting out, don't be a panic in the stock. They keep pointing to the stock market. And I've said, people don't, Joe Sixpack doesn't care about 7 stocks that are leading the S&P indices with the rest of the economy going. I mean, Biden lost because of the economy, full stop. Reagan won against Jimmy Carter because of the economy. Clinton won against Bush because of the economy. Trump won against Biden because of the economy. And if Trump
Harris, really, but yeah.
Well, Harris, but whatever.
Yeah, I know what you mean.
No, I got it.
Yeah.
But Trump now is, unfortunately, I don't know what his advisors are telling him, but yesterday, and I wasn't the only one to point this out, a lot of people who voted for Trump pointed out that he's gaslighting us, and people don't want to be gaslit right now. The reality on the street versus the 7 stocks hitting new highs. You cannot say I'm doing a great job because of 7 stocks. It's ridiculous. It's patently absurd. Consumer sentiment hit a new low today. The corporate markets are shedding jobs. They're going to blame AI. It's not AI. It's economic cycles writ large, hangover from the immigration, hangover from the housing market rolling over, hangover from the tariffs. It's all coming to a head. And
it's not all Trump's fault. It's probably just been building up for years too. You're going back to the Biden.
It's not,
and the jobs thing.
Yes, he had an opportunity though, and now I think unless he changes course and starts explaining to the American people what happened and why, if he doesn't do it soon, it doesn't matter what I say or you say, and we can say it's Biden's fault. The American people won't. The opportunity to communicate this and lay blame where it is passing quickly because you're gaslighting. It's not a good move.
Okay. What would be the communication strategy? Like, what if you were in that position or you could advise? What do you say?
I said in January, February, there needs to be fireside chats. We're going to cut government spending. The illegal immigration juiced the economy for 2 years. I'm stopping it. We're going to have a recession. And I'm going to do trade deals, and I'm going to bring manufacturing back. So we're going to have some tough times. But on the other side of this, we're going to have a golden age. Right now, we're saying the golden age is here. That's the problem. It's not here. The communication of and people are looking around going, what gold? Other than an oligarch or someone that's fat on 7 stocks, in their personal account, the average Joe Sixpack and by the way, job woes and layoffs are just starting to accelerate. Average Joe Sixpack is looking around. What golden age are you talking about, bro? So this is a massive communication problem. And he could have done
like in the fourth turning, yeah.
Yeah, and he could have done it, and they could still do it if they turn on a dime right now. But they're not going to listen to me. I'm just one dude that lives on Maui.
Well, a lot of people do listen to you when you come on this show, so you never know.
Yeah, maybe somebody will see it.
Yeah, maybe. Okay. I actually want to go back to China real quick because you've brought it up twice in this conversation. I can tell it's important, and it's probably not getting enough attention. Is China like a canary in the coal mine or something for like the global economy, or like how should we be thinking about it?
Well, China literally is facing a crossroads and a crisis, and it started in 2020, and they're about to hit the acute phase. They overbuilt their industrial installed capacity and their real estate. Everyone says, "Oh, China plant 100-year planners, and they're so smart." You got to go back after the great financial crisis to keep their economy going. They turned up government stimulus, and they built real estate well above the demographic demand. They overshot it like you wouldn't believe. So what do they have now? They have 20 years of excess inventory. 20 years. Okay, that killed a lot of internal consumption. They overbuilt their industrial installed capacity. So here we are. They have this population that needs to be employed. Their biggest fear is the people themselves. If people start to go and not be able to feed themselves, they have a revolution on their hand. I mean, there's 7 million party members with, I don't know what, 1.5 billion people in the country. So and that's why they have social credit score systems and whatnot. So China needs help, and China has 2 choices. They can try to export their way out of this, but then it destroys and wrecks other economies and other industries in those countries with deflation. Or they can produce a consumer-based economy. We could help them with that because they need to open up their markets so we can come in and like start selling stuff and whatnot. But they won't do that because they should do it. But when you give people a consumer-based economy with a real middle class, you give up power. And they don't want to give up power. So that's why it's a mercantilist system where most of the profits accrue to the very few there, and it's a slave system. So that's that they have a choice. They're at a crossroads, and they're going to come head to head with the U.S., the EU, Asia, and one of the ways that they can deflect from their internal problems is go to war with someone, create an enemy. So China is going to be a paramount issue for decades to come because they have problems. And when they have problems, we're going to have problems.
Yeah.
The other issue that most people don't understand is they have about 43% of the world's money supply. Now, a lot of that's trapped in corporations and rich individuals. And we have capital controls, but that money leaks out. They're going to be exporting deflation, but at the same time bidding on everything around the world, real assets, because they're depreciating their own currency. So we're going to have like deflation coupled with some asset inflation in assets that they want when they buy things in other countries. That's soft Chinese power. So this is a problem that's going to continue for decades to come, and it needs to be solved because if China wanted to, they could buy the world.
What is the solution then? Like, what is the solve?
The solve is, serious negotiations and adult talks about how they manage the crisis. And, they need to open up their economy. They need to create a consumer-based economy and give up some power. Absent that, we got problems, and we're just going to be in trade wars and whatnot. And we have to watch out for the soft power of Chinese money. And if Chinese soft power gets too big, there'll be capital controls, and we won't allow Chinese people to buy anything in this country. I think that's coming at some point.
Does that tie into any of the dollar liquidity drying up part of the conversation that we had earlier? Or is there a connection there or no?
No, not necessarily, but the dollar,
Okay.
because we're the reserve currency of the world. A lot of transactions and debt is denominated in dollars, and people are scrambling for dollars right now because things are getting tight. And the dollars are valuable because they're the best collateral to shore up margin accounts and other things. So that's why the dollar liquidity issue is going on. And I think one of the benefits of this recession that's coming is we'll be able to term out our short-term treasury bills into longer-term notes. So we're going to be able to do that, but it won't be because of economic growth. It'll be because of a recession. So our Treasury Secretary Bessent will have an opportunity to take. Yellen front-loaded our debt with the Treasury bill issuance. He'll be able to term it out at much lower rates.
Okay,
that's a good thing long term.
I do remember that Yellen did a lot on like the front end of the curve, like the short term Treasury bills.
Yeah.
Explain to me the significance of that if they're able to term out the short term Treasury bills into longer term notes because of a recession. Can you explain to me? I don't know, but what would be the significance of that?
Well, that would because one of the biggest concerns is if you rely too much on short-term financing, you're subject to capital flights if there's a problem. That's the third world problem. I remember Mexico was very heavily reliant in the 90s on their short-term financing, and there was something called Tesa bonos that were yielding way higher than US T-bills, and everyone was loving them until there was a problem. So you don't want to have to keep continually rolling over the debt. If you can term out some of this debt, it frees up the ability and gives you more flexibility. Janet Yellen really screwed up, and also when you issue a lot on the front end, it does helps juice the financial conditions of the market because that's pristine collateral. So when you issue a ton of T-bills, people will hypothecate that and create credit from that. And people keep pointing to this M2 chart. The M2 that's been created the last year and a half was not people think it's the Fed printing money. That's not the case. That's credit creation. That's Ponzi finance credit. That's all speculative at the end of cycle finance credit. And that, look at First Brands that just went bankrupt. That's the kind of M2 that we were creating. And that's all going to disappear. When you create money out of thin air, you can also disappear out of thin air. And every time you create a loan, you're creating money. So there's a lot of bad loans have been made, and private credit is an opaque industry. That's starting to buckle. The asset-backed market's starting to buckle. So we're starting to see these feedback loops. And housing, of course, is the underpinning of our credit system. That's going to become a problem pretty quickly.
Yeah. You did mention just First Brands, Tricolor. I forgot the other one. It's
PrimaLend. And what's interesting, Julia, is I remember I was on your show 9 months ago and I talked about the immigration problem. Mm-hmm. It's very interesting that all three are tied to immigration.
Okay, you're right. There is an immigration story. Yeah. Explain that too. And I want to hear a bit more on this because it's, yeah.
Yeah. So what's Ponzi finance? Tricolor was Ponzi finance. There was growth in immigrants coming in because of the Biden administration. And one thing to understand about growth finance stories, the faster you grow, the more ridiculous your credit standards are. Fast growth in a credit growth story always blows up. Growth finance stories always blew up. So when I was at BlackRock, we never bought growth finance stories because they always ended poorly. Tricolor was exactly that. It was taking advantage of the inflow of illegal immigrants, basically giving them subprime loans. And that was great as long as the flow was growing. They could, if you're growing faster than the losses accumulating, it looks good temporarily. Well, the flow of immigrants stopped. That's all it took. It just stopped. So their growth slowed and then their bad loans overwhelmed and they went bankrupt. That's Tricolor. And they were mostly subprime to legal immigrants without any, they didn't even have any documentation. They just didn't care. They were just giving them money. PrimaLend, same thing. And First Brands, while not directly related to immigrants was an aftermarkets auto parts dealer. So they probably on the incremental customer was illegal aliens, and they stopped showing up. So this is how it begins. It's like it's the tip of the spear, and then illegal immigration is also affecting rents. New tenant rents have been plummeting because they were sopping up the housing market rentals, which supports home prices. That's all going the way of the dodo bird, and that's why you're starting to see weakness in homes. We also overbuilt multi-tenant housing. We built because of the immigration influx. We built more units than we did during the 70s. That was the last boom, and those are already starting to roll over. So this is going to be not just single family units will get hurt, but this is a multi-tenant story. The other problem we have is that it's cheaper to rent than to buy, and you know how that ends. Mm-hmm. Home prices have to go below to incentivize buyers again. So it's cheaper to rent than to buy. Yeah. And that doesn't bode well for the housing market.
No, and I got to say, like, I am a millennial. I want to buy a home. I am holding out for now because to me, like, I look at housing prices since the pandemic, they're up 40, 50%, doesn't quite make sense. I could go buy a house if I wanted to, but I'm just like, I want to wait. But yeah, I kind of hear you. I feel like there's going to be, it's got to correct. It doesn't make sense.
One of our charts and one of our real estate reports that are available for purchase, we show homes for sale versus homes sold. And the time series, they usually track each other. The two lines are they go up and down like this. Well, homes for sale is like this, and homes sold is like this. It's like an alligator jaw. There's only one way that goes, and it's price. Price is the only correction to this.
And then to that point, how much, when you look at homes, like people probably have a lot of their wealth tied up in their homes. If you're a homeowner, you might really like what you've seen the last few years because of the price going up. Maybe look at your Zillow's estimate. It looks pretty good. I wonder how much psychology there is there where maybe you feel more prosperous because of the inflation you've seen in those prices.
Well, that's interesting. So homes cost, your primary home is where you live. You shouldn't view it as an investment. It's actually a cash burn. It's a cash burn.
Insurance, right? Property tax.
Insurance, property taxes, maintenance, upkeep. You name it. It's a cash burn. If you own second homes and rent them out, then you have to do the math. You need income to cover so you can pay your mortgage and all those other expenses. So those poor people that levered up to buy rental properties, if they're over levered, they're probably going to go underwater and lose those homes. If you are a homeowner and you saw appreciation in your house, unless you took out a HELOC, it shouldn't affect your psychology. If it does, well, I don't know what to tell you. It's not money until you turn it. It just because it's a value on a piece of paper on a website called Zillow. It doesn't mean anything. I'm not suggesting you take out a HELOC. Do not do that in this environment. But the bottom line is, if you own your single family home and you only have one property, you shouldn't care about whether it goes up or down. As long as you keep your job and you can pay your mortgage, you're fine. It's not a thing. Someone was asking me advice about buying. Their son was buying a home in Chicago. And I said, is it their first home? They said, yes. I go, are they going to live there a long time? They said, yes. I said, then don't worry about it. I mean, he bought it for, let's use bought it for $1 million. So it goes to 800 or, 700,000 in 2 years. Who cares? It doesn't matter as long as you're able to pay your mortgage. It just doesn't matter.
That's probably good advice, Ed. Okay. So we're hurtling toward a recession, as you put it in the conversation.
I think we're already in one.
I was going to ask you, are we in a recession now?
We're in one. We'll find out, a year or two from now when they do the official stats.
Okay. So we'll wait on that when we get that. I guess we're in a technical recession right now. I had other folks who said similar things, or at least put a probability on it that we are in one right now. Dr. Gary Schilling was on a week and a half ago. He said 60% probability that we're in one right now. So just throwing that out there.
I'm at 100, but look, I think 60 is very reasonable. I have a lot of
it's north of 50. Yeah. It's not a 50-50 chance. Okay. So just to round things out, and you kind of mentioned it earlier, like where you want to be, like treasuries and whatnot. Just from what you can share, like how are you thinking about this environment and how you want to be allocated?
I've said, I was early like Warren Buffett, and I've said you want to be, and again, this is up to you personally, where you are in your life. If you're young, don't freak. If you have a 401k and you're 30, raise some cash so you can, buy at lower prices. If you're near retirement, raise more cash, and then once the storm, we're in the thick of the storm, you go back in. You just want to have flexibility and opportunities to take advantage of what's coming, so you can sleep well at night. I never tell people what to do, but it's called dry powder. And I've done some consulting on the side with people, and a lot of people who call me are already well prepared. I guess it's more of a psychology handholding situation to make them feel good. So a lot of the people that have talked to me are already ready.
Yeah. Okay. What is something that is keeping you up at night? Maybe it's a risk that's not getting enough attention.
Japan could go, bye-bye at any moment. The Japanese carry trade is out there. Trying to figure out when that's going to blow up is, it's a black swan. You add that on top of what I'm talking about, which is an AI bubble popping and a housing crisis in China. That kitty barred the door. So that, Japan losing control would be devastating for the capital markets because there's so much leverage in the yen carry trade.
Wait, how would that work? I've had a couple guests who had talked about the Japan carry trade. Yeah.
If the yen carry trade blows up, it just means it'll be forced margin call selling.
Okay. And that will have ripple effects around the globe here in the US as well.
Around the globe, yeah. Mm-hmm. So that's what, that and I'm not calling that, because Japan is doing everything they can to manipulate that from happening. Yeah, they're doing, so that may not happen, but, it almost happened last August, but they fixed it.
And then before I let you go, what is something that's making you optimistic or hopeful?
Well, if these asset prices come down, and look, recessions are painful and bad, but there's also, on the bright spot, you come out the other side, asset prices are lower, millennials can participate and get, buy homes, and that generates a lot of economic activity. And oh, by the way, if millennials and young people have a stake in the country through asset ownership, maybe they won't elect communist mayors in New York.
Exactly.
I'm just saying.
I think you're right, though. Yeah, we wouldn't be electing socialist, communist, or whatever. I'm sitting here in New York. I don't live in New York any longer, but yeah.
So that's why I'm optimistic that there'll be good things on the other side. Millennials can, finally, get homes. When you have these asset bubbles, they really misallocate capital, and they send the wrong signals. And deflation in asset bubbles is not necessarily bad. There's always winners and losers, and the winners on this asset deflation will be young people. The boomers have had a good time. I don't know what to tell you. It's coming.
Well, I got to say, Matt and I are capitalists, just saying. We are millennials, we are capitalists. So if anyone's wondering, card-carrying capitalists right here. But anyway, Ed, I have to say, I always love having you on the show. You're so wonderful and amazing. I guess in the final 60 seconds here, where can folks go find you and support your work, subscribe to your work, get your research? Let them know.
Yeah, so on X, you can follow my daily musings at Dowd Edward, DOWD Edward. Our website is financetechnologies.com with a PH. You can buy our research reports. The China report is not priced for retail. So when you look at the price, don't yell at me. It's for institutions. It's a big report. It's very serious. And we offer, 2-hour consulting to anybody who buys a report. You can also find me at eddowd.com if you want to follow me there. As I'm currently platformed on X, we don't know what's going to happen in the future. So you can sign up for my email service. I won't blast you, and we'll see what happens. If I ever go dark, you can at least find me somewhere.
Oh, I don't think they're going to censor you on X. Hopefully not. That would be crazy. Yeah. But anyway, Ed Dowd, founding partner at Finance Technologies. So wonderful to have you on again. I want to get you back on in 2026, maybe when you put out your big outlook for the year. Really, really appreciate you as always. And I hope you have a wonderful weekend. And we look forward to our next conversation. Thanks again, Ed.
Thank you. Appreciate you.